Hello, this is Rochelle Agatha, and this lecture will cover current liabilities and payroll in relation to current liabilities. Just keep in mind that there is a separate payroll class that goes into more depth about payroll. This is payroll from an accounting standpoint, so let's get started. The objectives of this lecture are to describe and illustrate current liabilities related to accounts payable, current portion of long-term debt, and notes payable. And in the current liabilities section are the payroll liabilities. Determine employer liabilities for payroll, including liabilities arising from employee earnings and deductions. Describe payroll accounting systems and the use of the Payroll Register. And journalize entries for employee fringe benefits, including vacation, and we'll cover pensions very briefly. Describe the accounting treatment for contingent liabilities and journalize entries for product warranties. So let's start with current liabilities first. Liabilities are to be paid out of current assets and are due within a short, usually 1 year time period, are called current liabilities. So when you think of current liabilities, you think of less than a year. So the things we think of are accounts payable, current portion of long-term debt, and notes payable. So if you think of a long-term debt like a mortgage or a loan that a business would have, the piece that's due within the most current 12 months or year is the current portion of that long-term debt, and it's classified as a current liability on the books of the company. Accounts payable arise from purchasing of goods or services used in your operations. So it's what we've been talking about so far in relation to buying merchandise that you sell in your merchandising company. Long-term liabilities are often paid back in periodic payments called installments, and installments that are due within the coming year must be classified as a current liability. So this is what I was referring to a moment ago, that if you have a business loan, the current 12 months within the year must be classified as current portion of long-term debt, or a mortgage on a piece of real estate, etc. The total amount of installments due after the coming year is classified as a long-term liability. And why is that important? We're going to see as we move through this lecture that current liabilities are what the business owe right off the bat, and you need to have enough cash to cover your current liabilities, and we're going to test that at the end of the lecture. So that's the distinction of why you need to understand the current portion versus the long-term portion. The reader needs to be able to look at your balance sheet and see what's due within the most current year and what's due after that, and be able to look at your cash and short-term assets and see if you can cover it. Let's do an example. A firm issues a 90-day 12% note for $1,000 for an overdue account. So you take the account off your books, you issue a note, and you book a journal entry. Sorry, click too quick there. So here's your entry transferring the accounts payable out into a note payable for 90 days. Then on October 30th, when the note matures, the firm pays the $1,000 principal plus the interest. So you have your $1,000 plus your interest, and then you have the whole amount coming off in cash. On May 1st, Bowden Company purchased merchandise on account from Coker Company, the creditor. So the borrower's Bowden, the creditor's is Coker. And it's a $10,000, 2 and 10 net 30. And the merchandise costs Coker $7,500. So here's your transaction that you're used to. There, you buy your merchandise on Bowden's the borrower. They buy the merchandise on accounts payable. Coker's the creditor. So there's my accounts receivable and my sale, and my cost of merchandise sold and my merchandise inventory. So this comes from the merchandising chapter that we're familiar with. Then on May 3rd, Bowden Company issued a 60-day 12% note for the $10,000 to Coker on account. So he couldn't make the payment. So he got a note payable. So the accounts payable goes away and the note payable comes on. And with that ability for the borrower to do that, they're going to make you pay interest rate. So then Coker's going to have a note receivable, and the account receivable is going to go away. On July 30th, Bowden paid Coker the amount due on the note plus the interest. So it's a 60-day note. So the note payable comes off the books. There's interest expense on Bowden's books and cash of 10.2. And on Coker's books, he gets the cash. He recognizes interest revenue and notes receivable. So hopefully that brings all those chapters and lectures together so you can see bits and pieces of it coming together now in this type of a transaction. On September 19th, a firm borrows $4,000 from First National Bank by giving the bank a 90-day 15% note. So they get the cash and they get notes payable. So there's the entry when the firm gets the cash and has the debt incurred. On the due date of the note, which is December 18th, the borrower owes $4,000 plus the interest. So it was a 15% 90-day note over 360 days, so that's $150. So the note is taken off your books. There's interest expense for the $150, and there's cash for the total amount that you paid. There's a term called discounting a note, and this is kind of an advanced accounting topic that you'll talk about more as you take more accounting classes, but I do like to mention it in beginning accounting. The interest set by a creditor when a note does not specify the rate is called the discount. So the rate used in computing the discount is called the discount rate. The borrower is given the remainder called the proceeds. So what this is think of it like the note has the interest already embedded in it, and this is a commonality. So on August 10th, Carey Company issues a $20,000 90-day note to Rock Company in exchange for inventory. Rock discounts the note at 15%. So Carey wants inventory, Rock gives them debt. And it's called a $20,000 note. So the inventory is bought. There's interest expense, and there's the note. So notice that the note comes on the books at the $20,000. The inventory is only valued at the cost because the $750 is imputed as the interest expense. On August 10th, Carey Company issues a $20,000. Okay, sorry, we're going to keep going here. I'm going to show you that here's the proceeds. So we're still in the same transaction. The proceeds were the $19,250. The discount is the rate times the time times the principal. So it's the $20,000 times the 15% times 90 over 360 days. So that's how they got the amount. And the balance, there's the discount rate. And the balance is the $20,000. So you have to know how to calculate the interest to back into the inventory when you're in a discounted note situation. So the key to this is just remember, if it's a discounted note, it includes the interest. The note goes on your books at the full amount. You calculate the interest expense, and the inventory or asset or whatever you bought is the difference. On November 8th, the note is paid in full. So the note comes off your books, and there's the cash. Notice you recorded the expense, the interest expense at the time that you purchased the inventory. Let's give another example. Bella Salon Company issued a 60-day note with a face amount of $60,000. Determine the proceeds, assuming an interest rate of 6%, and determine the proceeds of the note, assuming the note is discounted. Okay, so here's our two scenarios. For A, it's $60,000, and for B, it's $59,400 because the $60,000 includes the interest, the 6% at 60 days. So print these out. Don't get too hung up. Like I said, this is an advanced accounting topic. A lot of beginning accounting instructors don't cover it, but I think it's important that you understand the terminology. Objective 2, determine employer liabilities for payroll, including liabilities for all the things that related to an employee and their deductions and their earnings. Payroll refers to the amount paid to employees for the services they provide. So most of you have probably been an employee, and some of you might have even been an employer in some form of capacity. So I think payroll is really important for any accountant to understand from an accounting side. Understanding the payroll side as a payroll technician is important too. And if you are ever going to be a CFO or an accounting manager, I think it's really good to know how to do payroll. I personally did payroll. I've done it a couple times in my career, and it makes you really understand all the things involved in payroll and the cost to an employer and what, the systems that you need, etc. Employees are sensitive to payroll errors, so it's really important that you have a good payroll system and you have trained employees doing payroll. The payroll is subject to various federal and state regulations. It's heavily mandated, heavily looked at, so it's important that you have your checks and balances in place. And the payroll and related payroll taxes have significant effect on the net income of most businesses. I know I've worked in several different industries. Salaries and wages and bennies are typically, 60% or maybe even more of a company's expenses. And it's really important that you understand how to record this stuff. Wages usually refer to the payment for manual labor, both skilled and unskilled. The rate of wages is normally stated on an hourly or weekly basis. Salary usually refers to managerial or exempt staff who receive a weekly, monthly set money. It's not hourly. The words are used interchangeably in the industry, sometimes they're just referred to as labor expense. The total earnings of an employee for a payroll are gross pay. From this, you subtract deductions to arrive at net pay. So gross pay minus deductions equals net pay. That's key there. Let's go an example. McGrath is employed by McDermott at the rate of $34 per hour plus 1.5 times for OT if he works more than 40 hours a week. For the week ended December 27th, he worked 42 hours. So he has his 40 hours at $34 an hour. He has his 2 hours at $51 an hour because that's time and a half. And his total earnings are $1,462. Now we're going to talk about some taxes. And as I mentioned, this is overview. You're not expected to be able to truly calculate payroll, but I want you to see that there's different tax tables. And if you're doing payroll nowadays, 9 out of 10 companies, probably even 9.9 out of 10 companies are using a payroll system. They're not doing it by hand. But it really is important to understand it from a manual point of view, to see the things, because once you do it in a system, do a payroll in a system, you lose track of what you're doing because it's all data entry and calculations within a computer. So let's assume for the standard withholding allowance is $63, and this came from an IRS chart. So an employee has state and federal taxes, if you live in California, along with some other stuff. So this is a calculation of the federal tax. So as you all know, as an employee, you decide how many, if you're single or you're married, and how many deductions you have, etc. And there is a publication 15 from the IRS, and it tells you how to calculate the taxes. And if you use a computer system for your company, the tax tables are loaded in the computer system and updated every year when the IRS updates them. So this is from 2006. So looking at this, McGrath fell in this wage group. So it's $78 plus 25% of the difference in the base. So let's give his example. He had initial withholding of $78.30 from the chart before, plus he had the $13.99 minus the $620 times that 25%. So I'm going to go back. See right here, he had the $78.30 less he needed the 25% on top of that. Okay. And then he had total federal income taxes. So you're not going to have to necessarily do this for a test in this class, but I want to make sure that you understand this. Okay, so let's look at Karen Dunn's weekly gross earnings for the present week are $22.50. Dunn has 2 exemptions using the wage bracket withholding table in Exhibit 3, which was slide 31, with a $63 standard withholding allowance. What is Dunn's federal income tax? So you can print all these things out and kind of follow through with what I'm saying. There was a total wage of $22.50. There was the $63 of allowance times 2 claims is $126. So the amount subject to withholding is the $21.24. Then you calculate the tax on top of the taxable base. So you have $275 from the chart, 55, plus 28% of the excess over $1409. So go ahead and just print these out and make sure that it makes sense to you, from a big picture standpoint, that is how your tax is calculated. I find payroll pretty interesting, but maybe I'm just an accountant at heart. The amount of FICA tax withheld is the employee's contribution to 2 federal programs. The first is Social Security. It's for old age survivors and disability insurance. And the second program is called Medicare. So you've heard these terms probably as an employee. Social Security, OASDI, Medicare, and it is, these are federal programs. So John McGrath had earnings subject to 6% Social Security. So he had $962 there. And Social Security tax rate of 6% is a Social Security tax of $57.72. Then there's earnings subject to 1.5% Medicare. And then there's the Medicare tax rate. These bases change. the base that the tax is built on changes from year to year. So this is just a stagnant example in time right now. So the total FICA tax is made up of the Medicare and the Social Security for a total of $79.65. So here's his net. There was his gross. There was his Social Security. There was his Medicare. There was his federal income tax. I think I have the slide number off on the Social Security because it was the previous slide. There's the retirement savings. And there's some United Way deduction. These are things that we'll talk about in a little bit. There's his total deduction. So of what he makes, these are the total deductions coming out so far. Now, if you live in California, you're going to have a state tax here too, or most other states. So there'd be a state tax coming out of here too. Okay. So his net pay is $1,084.30. That's kind of how it works from a very big picture. So let's look at Karen Dunn. Here's her information. And let's watch how she gets calculated. There's her total wage. There's her federal income tax. There's her earnings subject to Social Security. There's her Social Security tax. There's her Medicare tax. There's her net pay. So employers are required to contribute to Social Security and Medicare also. So besides taking it out of the employee's check, the employer has to match each contribution. Along with that, they pay food tax, which is levied on employers only, and it's unemployment tax. So the employee doesn't pay this, the employer pays it. And at the point of this time, it was on the first 7,000 of earnings each covered calendar year, and that does change. Employers in most states also must pay a state unemployment tax. In California, it's called SUTA, and some companies are self-insured. So I'm not going to get too detailed into that, but remember there's a FUTA piece and a SUTA piece. So here's the responsibility for tax payments. The employee is responsible for Social Security and Medicare and federal and state. The government is in the middle, and then the business is responsible for the matching Social Security and the Medicare, the federal unemployment, and the state unemployment. And they are also responsible for submitting everything they yank out of the employee's check to the government being the federal and the state. Let's describe payroll accounting systems and payroll registers and earning records. The payroll register is a multi-column report used for summarizing the data for each payroll period. Now, this is a manual system. Think about a computer. A computer is going to have a computerized version of this. And in the payroll register, you're going to distribute all the different accounts. So here are, whoops, I went too fast. Here are all your employees. Here's how many hours they worked. Here's their regular, their overtime, and their total. Okay, so here's their earnings. It's the first set of columns. Then here's all their deductions. Social Security, Medicare, federal, retirement, miscellaneous. So here's their total of deductions. So here was their earnings. Here's their deductions. Then there's the net. So you can see, let's talk about, then you pay them by check, and here's where it gets debited. So if you're a merchandising kind of company, you're going to have some employees as sales salaries, some as office salaries. And it goes to different accounts. Okay, so this one says AR because these miscellaneous things probably are like employees owe money for certain, maybe they bought uniforms and they have to pay it back, or they bought meals or something like that. So that it's just a way for you to know where all the different accounts go. So let's record employee earnings. So here's the sales salary expense, the office salary expense. Here's all the payables for the taxes. So I'm going to go back real quick. Okay, so here's the total earnings. Okay, here's all the deductions, and here's the breakout of the different salaries right there. So there's the salaries. Here's all the deductions with the receivable here that the this Fred person paid. The net of the wage less the deductions is salaries payable. And that's how you get it. It's the net of all of the deductions. So let's do an example of Chen Engineering indicates $900 of Social Security withheld, $225 of Medicare, salaries of $15,000, federal withholding is $2,925. So we're not worrying about how we got this. This information is provided. Here's your entry. Salary expense, Social Security payable, Medicare payable, federal tax payable, salaries payable. This is the net of this minus these deductions. Everson Company fiscal year ends on April 30th. He owes its employees $26,000. The following portion are subject to payroll taxes. So here's the different, this is just another way to look at it where they're actually going to make you calculate it. So here's the Social Security. Here's some information for McDermott Company. Social Security tax, Medicare tax, state unemployment tax, federal unemployment tax, total payroll tax expense. So here you can see the federal rate and the state rate at the time this example is given. So let's do the journal entry. Here's our payroll tax expense. Here's all the pieces. So I call this the employer entry. It's the employer entry for the payroll taxes owed by the employer. Unlike the previous entry we did, that was the employee side where we recorded the debit to salaries and the credit to the deductions. The net was salaries payable. That was the employee's entry. This is the employer's entry. Okay, the Payroll Register of Chen Engineering Services indicates all this information. Provide the journal entry. Okay, so here's our payroll tax expense. Here's our different payables, and that's our employer entry. It's payroll tax expense and liabilities. And the reason they're liabilities is because you don't pay it when you prepare your payroll. You wire the money. Typically, people wire it later, and then the payable is released when the cash payment is made. A detailed payroll record is maintained for each employee, and that's the employee's earnings record. At the end of each pay period, payroll checks are prepared. So here is John McGrath's payroll earnings record. It's his information by date, his earnings, and by type of category, and all his deductions and his amount paid. So envision this in a computer system. You would be able to pull up any employee in your payroll system and look at their earnings record. Same thing, just in a computer instead of on paper. And this is what a check would look like. I'm sure all of you have been paid before, so you can kind of look at your paycheck and see, well, here's what I made. Here's my gross pay. Here's my net pay. Here's everything that came out of my check. And I truly think you should always look at your paycheck just to see if something's coming out. Like maybe you didn't decide you wanted a United Fund, or you didn't buy a U.S. savings bond. You need to look at your pay stub and make sure that it's what you thought it was going to be. Here's the flow of payroll data in a system. And you can see that you have your constant data with your rates of pay, your taxes, etc. You have your current period variables, hours of work. Your updated variables are your taxes and your earnings. Then you have your payroll register. You produce checks and statements. All that information goes to the financial statements, and it also goes to the payroll side of life, the W-2s, etc. So I really like this diagram. I think it's pretty good overview. Let's talk about fringe benefits a little bit. Everybody likes to get paid time off. You might call it sick time, vacation time, paid time off. And here's just a little graph, but honestly, from my experience as a CFO in several different industries, benefits can go anywhere from 15 to 30%, depending on what type of industry. They're much higher in the government because of the retirement that governments typically pay. In healthcare, it runs about 26%. So when you hire someone, you know that you're going to pay them their salary, but you're also going to tack on another 26% on top of that as bennies. So most employers grant vacation rights. So here's an example where you have your vacation pay expense and your vacation pay payable. And this typically comes in an accrual every month for most companies. They estimate the average amount of PTO that employees will use for a year, and then they spread it out over the months. If you have thousands and thousands of employees, like where I currently work in healthcare, this is a huge accrual. And if you have a computer system, it will typically base the accrual off of a trend or recent usage. I'm briefly going to mention pensions. Pension represents a cash payment to retired employees, and pension accounting has been under fire for the last 5 years. and it's become increasingly more complicated. So all I'm going to mention here is that there are basically two types of plans. A defined contribution plan is a fixed amount of money invested on an employee's behalf during the employee's working years, hence defined contribution. A defined benefit plan, employers promise employees a fixed annual pension based on a number of years of service. So if you work for the government and you belong to PERS or the state STRS, you have a defined benefit plan. When you retire, you're going to get a certain amount of your salary. Most private companies have defined contribution plans. They don't promise you anything. Pension accounting is quite complex and is covered in advanced accounting or even in pension accounting classes now at accounting institutes. Okay, let's describe the accounting treatment for contingent liabilities and learn how to journalize product warranties. Some past transactions will result in liabilities if certain events occur in the future, and these potential obligations are called contingent liabilities. These range anywhere from legal obligations, insurance-related things, and then the product warranty side of life. Contingent liabilities are only recorded when they are probable and can be reasonably estimated. Otherwise, you do not book a journal entry. So let's say you just got sued, and your company got sued, but you have no idea anything about it. You don't know how much. It's not reasonably estimated, and it's not even probable at this point. You don't do anything. Okay. However, if 6 months go by and attorneys have been contacting you, there's been discussions of settlement, you know how much it might be, then you're going to book a liability for something like that. So let's do this this type of example. A company sells a product for $60,000 in which there's a 36-month warranty. Past experience indicates that the average cost to repair defects is 5% of the sales price. So what you do is you book a warranty expense and a warranty payable for 5% of the sales price. And this is very simplified. People who have warranties in their businesses have a complex analysis, but for the purpose of this example, I want you to see you need to book an entry. If the customer required a $200 part replacement, the entry would be against the warranty payable and supplies. Notice it didn't go into warranty expense at this point because you were estimating it, kind of like we did allowance for doubtful accounts in AR, and then we wrote accounts off through the allowance account. It's the same purpose. Here, you're estimating the expense based on sales, and then when something happens, you take it against the liability. Here's a nice diagram for contingent liabilities. If there's a contingency, first you say, is it possible or probable? If it's possible, you just disclose it in your financial statements. If it's probable and not estimatable, you disclose it in your financial statements. If you can estimate it, you record it and disclose it. Okay, so here's your diagram. So here's Cook-Wright Inc. sold 140,000 of kitchen appliances, and we're going to provide journal entries for their estimated warranty expense. Here's our product warranty expense at 6% of the sale. Then when they come back and they replace the defective part, it comes out of product warranty payable, supplies, and wages, because it was supplies and wages. Okay, I want to mention just two quick ratios here, a quick ratio and a current ratio. The quick ratio talks about quick assets. Quick assets are cash and accounts receivable. That's it. And then you're going to calculate your quick ratio as your quick assets divided by your current liabilities. Because what this is telling you is, could you pay off your current liabilities with your quick assets? It's also referred to as the acid test ratio, and it's used to evaluate a firm's ability to pay its current liabilities within a very short period of time. So let's do Noble first. Noble has a 1.05, and anything over 1 in the industry is deemed to be good. Hart has a 0.8, so Noble has a better chance of paying off current liabilities than Hart does. In summary, we talked about current liabilities, specifically AP. We discussed what current portion of long-term debt is. We talked about payroll liabilities, payroll taxes, payroll systems, and contingent liabilities. As you move through any homework, let me know if you have any questions, and if not, look forward to the next lecture.